First of all, thanks Morten and Adina for having me here today, especially considering that regulators and central bankers are rather a minority in such events. I'm in task with providing some debunking myths over CBDCs, provide you a global perspective on what those are. I will focus mainly on the retail side of the CBDCs and also provide some motivations that central banks have for basically engaging in a CBDC exploration, and also some principles that we keep in mind in terms of design. As an economist, I talk a lot about money. I talk about money supply, I talk about money demand, I talk about money functions and money forms. Historically, money has had continuously three main functions, right? So it's a means of exchange. You exchange goods and services in exchange for money. It's a unit of account in terms of measuring economic value, and it's also a store of value, right? You can save up money for future use. Public money, as we know today in the form of banknotes and coins, has been historically deeply intertwined with a nation's sense of pride and identity, right? So global interoperability has never really been the goal. Quite the opposite. Countries tend to distinct themselves from other countries, like, you know, the banknotes, the euro banknotes, where you see those bridges that represent connecting Europe's past, present, and future, or, you know, the 50-pound banknote that depicts Alan Turing to celebrate his accomplishments in science. Now, when central banks or policymakers are faced with the dilemma whether or not to issue a CBDC, I think there's three questions that they tend to ask themselves. The first question is, why do we need this? What problem are we trying to solve with it, and how will this future look like in practice? Before I answer these three questions, I think it's important to understand what CBDCs are and what they're not. So a CBDC is essentially a digital asset that is issued by a central bank for the purpose of payment or settlement in either a retail or a wholesale form. Sorry. Now, a lot of people ask the question and they say, well, my money is already digital. Why do I need a central bank digital money? And I say, yes, your money is already digital, but the money that you hold digitally in your bank account, that is not public money. So that is not a liability of the central bank. What is a liability of the central bank is cash, which is accessible to all of us, right? And it's in a physical form. Then we have central bank deposits. That is digital, but we don't have access to central bank deposits. Those are basically reserves that commercial banks hold at the central bank. And the CBDC would be basically a complement to these two types of money. What is a liability of a private entity? It's, of course, the bank deposits you and I hold with our banks. It's electronic money like Google Pay or Apple Pay, and also, as of recent, some stablecoin initiatives and arrangements. What is not a liability is, of course, crypto assets, but that is not the focus of the conversation today. Now, when we look into this map, you'll see that around 130 countries globally are actually exploring a CBDC. Some of them are in a rather early phase, so just research, and most of them are actually in advanced phases, be that a pilot, like in China, or already launched. So there's 3 countries globally that have already launched their CBDC, and that's the Bahamas, Nigeria, and Jamaica. I think a lot of people say that CBDCs are a response to Facebook's announcement of Libra back in 2019. Some others say that it's in response to the digitalization of payment. I personally think that's a response to the digitalization of society, right? So in a society where digital technology becomes the norm, it's important that public money remains available in a digital form too. CBDCs can, of course, play this role. Now, there is different motivations why a central bank would decide to engage in an exploration of a CBDC. And here I've listed some of the most common motivations that central banks have nowadays to issue a CBDC. The first one is to ensure monetary sovereignty. But what is monetary sovereignty? Monetary sovereignty essentially means 3 exclusive rights. That is one, the right to issue a currency within its territory. The second right is to determine the value of that currency within a territory. And the third right is to oversee and regulate the currencies that are within that territory. Now, central bankers fear a little bit that with the new emergence of payments, mainly by private entities, there could be a displacement of domestic currency, and therefore they would lose their ability as a lender of last resort. The second reason, or the second motivation, is the response to the decline in cash. Now, this is a phenomenon that we see globally, yet people value cash. In the Eurozone, for instance, the relative share of cash payments to total payments was only 59% in 2023 versus 86% in 2019. Now, this is, of course, a big part due to the COVID pandemic, right? When a lot of stores we could not pay with cash, it was only digital. But why do central banks care about the decline in cash? Well, public money, or cash, serves as a monetary anchor. That means that it ensures a full convertibility of private and public money. Essentially, like €1 coin in my pocket is the same as €1 coin in my bank account, right? So this principle of the singleness of money is ensured with public money. Third motivation is to improve the payment efficiency. Now, payment systems are typically characterized by large network effects and economies of scale, which means that only a few monopolies are out there that dominate the markets. With a CBDC, central banks can offer basically a platform that these payment service providers can innovate and compete more efficiently in the market. The fourth reason is to increase resilience during crisis. We saw during the pandemic how important all of a sudden central bank money became, right, in distribution in order to recover the economies. Now, of course, we have the climate crisis, which is undeniable, potential natural disasters happening. So CBDCs could actually be easily distributed even in areas that it's hard to reach. And lastly, driving financial inclusion. This has been said over and over again. It's particularly important for communities or populations that have a large underbanked or unbanked community, right? It's also important to be a bit realistic that the creation of a CBDC in itself will not drive financial inclusion, but the marketing efforts and also the design principles will or can have the ability to do so. I think nations with very robust and efficient payment systems may think that they do not have much to, fix or address with a CBDC. At the same time, it's important to be a bit long-term, to have a long-term vision, right? And think, what will this world look like in 10 or 15 years from now? In other words, basically like future-proofing your domestic currency. And I think this is very nicely depicted by this quote from Powell, the head of the Fed, when he said, "It's our obligation to understand it well and not wake up one day and realize that the dollar is no longer the world reserve currency." This fear of missing out, I think, plays quite a big role as well as to how and why central banks are engaging in exploring CBDCs. The Bank of Israel, for instance, announced that they will consider issuing a digital shekel if the US goes ahead. The Central Bank of Sweden, similarly, they're closely monitoring the developments of the digital euro in Europe. Enough about the motivations. I think the design choices are very, very important in providing a successful CBDC. And I think that the design choices should be centered around policy objectives of policymakers, but it's important to keep into account the user needs. So what are the user needs, right? We have users that prefer a cash-like functionality, that they are able to conduct payments peer-to-peer. They want convenient real-time payments available 24/7, 365 days a year. They value privacy a lot, but I will touch on privacy in a bit. They want it to be accessible to all, and potentially whether there will be any interlinkages between wholesale and retail, and whether they can pay cross-border too. Now, on the right-hand side, we have the design choices that central banks can make. Starting from the bottom, starting from the architecture, whether the CBDC will be a direct or an indirect claim on the central bank. So a direct claim basically means that the central bank issues and distributes the CBDC by itself. An indirect claim would be using financial intermediaries. Going up the ladder, so these lower decisions will feed up on the higher hierarchy. Then we have the choice whether to make it a DLT based or using a conventional central bank infrastructure. Another choice and another distinction that I will make in a second is in terms of access technology. Like, do you have an account or a token-based access technology? And finally, as I mentioned, the interlinkages between wholesale and retail. Many central banks are actually in favor of a two-tier infrastructure. That means that the central bank carries over the infrastructure tier. They are responsible with issuing or minting and burning or destroying CBDCs according to market demand. But then they outsource the distribution to financial intermediaries, such as banks, PSPs, even consumer tech companies, right? And they're not only responsible for the distribution, but also for performing some basic compliance functions. And of course, on the other hand, we have the payment tier, which consists of retail customers like you and I, and also merchants. So merchants would have to enable the POS payments or e-commerce payments with the CBDC as well. Another thing that central banks really agree on is that a CBDC will not be programmable money, right? So a programmable money is having restrictions as to what and why you can use that CBDC. To quote Fabio Panetta, who is actually the central bank governor of Bank of Italy, he said central banks issue money, not vouchers. Of course, there's a distinction between programmable payments. We already have programmable payments, right? I can set up a payment, a recurring payment, every month on any given day to a specific account. But it won't be programmable money. Now, in this two-tier infrastructure, let's look at some of the players and beneficiaries in this CBDC ecosystem. Of course, the first ones are the central banks that would issue the CBDC, but also they will need to provide like a ledger for settlement where the intermediaries can actually settle. The second player would be financial intermediaries. They would be tasked with distributing the CBDC to the end users to verify, execute payments, and sometimes, of course, provide value-added service to customers. Next, we have the regulators, and I think this is a very important role as well because they will have to update the existing legal frameworks in order to ensure that the CBDC is actually considered money. Finally, we have the merchants and the end users. The merchants would have to enable the CBDC payment online and at POS. And the end users, of course, will have to educate ourselves, understand what the CBDC is, and then acquire a digital wallet. Privacy is the most important design principle from a user end perspective, right? And typically we have this trade-off between privacy on one hand and financial integrity on the other. Where do retail CBDCs stand? If I am to depict this relationship on a very simple scale, on one hand we have privacy. Cash is of course the most private means of payment, so if I give 1,000 euros to Morten, nobody monitors that transaction. So we have high privacy, but very little financial integrity. On the other hand, if we are to give up some privacy, then we have quite some financial integrity. That means, customer due diligence, CDD, KYC, AML, and all the law enforcement sections. Similar to bank deposits nowadays. What CBDCs offer, they offer this traceable anonymity, which means in principle, you or the central bank will not actually see your transactions, but if required, it would be easy, hard, but still possible to actually trace back to the end user. So in this context, central banks have a few decisions to make. The first one is to be fully transparent to the central bank, so all the transactions. But this is not something that central banks like, because it won't really increase the popularity, not among users and not among, the general public. The second option is to be transparent to the intermediary, right? Similar to bank accounts as we know nowadays. A third option would be to have a privacy threshold. That means for lower value payments, you have a lot of privacy and not so much financial integrity. But for higher value payments, then you'll have to conduct all the checks required. So the CBDC basically offers both the benefits of privacy without necessarily compromising on financial integrity. And I think this is a very difficult task because everyone actually thinks that there will be a surveillance state. Another aspect of the design choices that central banks need to make is in terms of access technology. So will it be an account-based or a token-based access? So an account-based access that is very similar to the bank deposits as we know nowadays. And the story goes like this. So I am, therefore I own. In this case, ownership is actually tied to the identity of someone. So if A says I am A, transfer 1 from my account to C's account, and the identity of A and C is known, then the transaction takes place, right? In a token-based access, it is a little bit different. So here the story goes like, I know, therefore I own. So ownership is actually tied to the knowledge. And knowledge could be, in this case, a digital signature. So if a private key A, right, a string of numbers and codes, says transfer 1 from address A to address C, then we will have a public key A, which will verify that this private key A was used to encrypt, and then the transaction takes place if this digital signature is correct. I think, yeah, the easiest way, I think this is a bit harder to understand from the account-based access, but the easiest way to describe it is through an example, right? So if I pay for my coffee to a merchant with a bill, the merchant doesn't need to know who I am. They only need to know that the bill is not counterfeit, it's not fake, right? So this knowledge-based principle could be easily implemented into this account-based system. Central banks, the jury is not out yet what they will implement. Some are more in favor, like Bundesbank, Germany, that value privacy a lot more. They value this token-based access, and they have been vouching for it for years. Other central banks, they think that the system, like we know it nowadays with an account-based, like cash current account, it's actually okay in terms of privacy. And of course, there will be more infrastructure and time commitment needed from central banks to develop this token-based access. Now, I think I've spoken about the motivations, the design principles, but there's a lot of challenges with the CBDC implementation. And here I've listed only the most important ones, or that I think are the most important ones. And among these 5, I think the public interest and trust is actually what can make or break CBDC implementation. I was cycling in Amsterdam the other day, and at the traffic light I saw no state surveillance, no CBDCs, right? So this misconception of what CBDCs are tell you a lot. In this regard, the trust and public interest varies a lot per jurisdiction. And of course, political support is very important here. This was actually one of the reasons why, actually the main reason why the Central Bank of Ecuador decided to discontinue their CBDC, because they could not gain mass traction. So there was no interest and there was no trust, primarily in the central bank, but also in the government of Ecuador. Another challenge is implications for financial stability. And with this, I mean mainly bank disintermediation. So there's a lot of bankers in the room. If a CBDC is viewed as the most risk-free asset, especially in times of crisis, then end users can actually withdraw deposits from their commercial banks and put them into a CBDC, right? So then banks will have bank runs, or at least will have to find alternative means of financing, which are typically riskier or more expensive if they have to go in the wholesale markets. But there are ways in designing a CBDC that can actually mitigate this, and I will show that when I do a deep dive on the digital euro. A lot of central banks have also been very much proponents of an offline use of a CBDC. That means that you can access an online CBDC with your digital wallet, but also an offline through a physical card potentially. Now with the offline use comes the risk of double spending. So someone pays offline and then they reattempt to do the same thing online before the transaction is settled already, right? Before it shows in the online system. So it's important to strike a balance between security on one hand and usability on the other, because if the measures are too strict, then it really discourages people from using it, and if the measures are too relaxed, then you have, of course, an increased risk of double spending. Cybersecurity, I think I don't need to say much about this. It's actually prone to cybersecurity, starting from data manipulation, data breaches, system manipulation, but also statewide attacks, right? And in this context, coordination with other central banks is very important to obtain best practices and key learnings. And finally, interoperability, right? I think central banks are too much focused on a domestic use of CBDC. So if all the central banks focus primarily on a domestic use of a CBDC, that would make cross-border payments even more cumbersome than they are today. So coordination, again, is very crucial for ensuring this future-proof CBDC that lasts. Given all these challenges, central banks are actually adopting a process similar to an agile product development methodology, right? Starting from preparation to proof of concept, to prototypes, piloting, and finally production. We call this, in central bank slang, a dynamic decision-making framework, right? So at any given point in time, you can decide to proceed, if all is well, to pause, to get new insight, new information, or to iterate, or to exit altogether, right? Now, let's see how the digital euro, which is actually the pan-European retail CBDC, is trying to get by some of these challenges, right? So the digital euro would be a pan-European CBDC used by the residents and also the citizens of the euro area members. It would complement cash, it would serve different societal needs, and the key design is to bring the most liked features of cash into the digital euro. So in terms of use cases, you will be able to pay peer-to-peer, in-store, POS, but also e-commerce. It will be both online and offline, either in a consumer device being our mobiles, or a card if we're talking about the offline use. In terms of consumer interface, the ECB is thinking of having a standalone digital euro app, but it can also be integrated into the intermediaries' interface. Again, the digital euro will be a two-tiered ecosystem in terms of architecture. So the euro system, comprising of the ECB and the national central banks, they will be responsible primarily for the settlement, but everything starting from end-user onboarding, servicing, but also post-settlement and offboarding, they will actually rely on the intermediaries, which will be supervised. Last June, the European Commission actually launched the initial draft proposal legislation as to what the digital euro is and is not. First and foremost, the digital euro will be legal tender. That means that the courts of law recognize the digital euro as a payment, similar to cash. As I said, distribution will be done via banks and PSPs. It should be easily portable. That means that if a consumer does not want to continue their relationship with their PSP or their bank, they should be able to take their holdings very easily and transfer them into another PSP. In terms of financial instability and the potential for bank disintermediation, we have agreed that the digital euro should have no interest to discourage people from actually holding or hoarding the digital euro as a store of value. And at the same time, there will be some holding limits to it. Now, initial models show that a 3,000 euro cap is enough to not cause bank disintermediation, but the final limit will be agreed towards launch. It will be free of charge, at least for the basic functionalities and basic services. And also there is a very important emphasis, I think, on the privacy and the data considerations around the digital euro. So in the online version, the intermediary will be able to see the transaction data. In the offline version, even the intermediary may not see transaction data. And in terms of the role of co-legislators, I think they will be, critical. So for the online version, co-legislators will try to explore higher privacy for lower value payments, just like I mentioned earlier, and then for higher value payments, the intermediaries will actually see the data. And for the offline, we are thinking that co-legislators might actually exempt completely, proximity payments in case they happen, just like with cash from the transaction monitoring. But again, there will have to be a threshold there. Now, as to where do we stand, as of November last year, 2023, we've entered the preparation phase of the digital euro. That means the initiation and experimentation. There are two main milestones to be achieved here. The first one is a rule book on the digital euro, which encompasses all the principles of what the digital euro should contain. But also, it's basically tendering for providing the underlying technology to build. So if there are fintechs in the room that think that they have what it takes to provide the technology, go to the ECB website. There are 5 open calls for applicants. So that will basically take 2 years until 2025. I think the earliest we will have a digital euro operational will be 2027, 2028. But all that said, it will rely a lot on the European Parliament elections that are this year. I think Parliament will have quite a say as to whether we will have a digital euro in the first place or not. But again, I'm only here as a central banker. Finally, I wanted to conclude my presentation with this great quote from American futurist Roy Amara, who said that we tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run. Yeah? So let that sink in for a bit. I think it's very important that we are both optimistic and realistic as to the effects of the technology and what that could mean for our life, right? We typically focus on the short-term benefits and think this is going to be a game changer. And in reality, very often, in hindsight, nobody could have ever imagined the potential of that technology. So I think by keeping this in mind, we can better, navigate the technological landscape and also make some better informed decisions on the future of CBDCs. Thank you very much. I'll be around, so